Tax season is here, and while most people file their taxes without problems, others might be audited.
So what are some of the red flags that may initiate an audit, and how should you be prepared just in case it's you? TV6's Jennifer Perez finds out in tonight's Consumer Watch.
If you receive an audit letter like this from the IRS, it's more than likely because you're claiming high expenses.
They're double checking this to make sure you didn't, claim too much. They're basically verifying your information.
So what are some of the common red flags the IRS looks for to issue an audit? Some instances include reporting high losses with a business for consecutive years, claiming a high amount of travel expenses, claiming an office in your house, or high amounts of charitable donations.
If you're claiming $10,000 instead of, for charitable contributions when the parameter is about $3,000, that might draw a red flag.
Jim Hakinen with UP Tax and Accounting says many times audits may be sent out 1 to 2 years after you filed your taxes. That's why it's recommended to keep all the documentation necessary to back up your claims for several years after filing your returns.
The form of payment plus the receipt, so it's important to keep the receipt also, not just if you pay a bill with a check, the IRS does not have to accept that.
If the audit reveals you claimed too much, you can lose the deduction and be required to pay it back. But before submitting any documentation or money to the IRS, it's best if you get input from an accountant. Jennifer Perez, TV6 News, Marquette.